Alright, my name is Nick Traxler, and I will be describing hedge funds to you guys today. So just to give you guys an idea, the scope, these are just regular funds that manage assets in the world. You see that Vanguard is the most, but of hedge funds, and AUM is assets under management, but hedge funds control, at least the biggest one has $197 billion in assets. You're approaching the bottom of just regular fund asset value. So a hedge fund is just basically, it's a fund that pulls a lot of money from private investors, and which is invested by quote-unquote accredited investor, and they're usually invested in speculative ways. You have to meet certain requirements. The net worth of the accredited investor has to be over 1 million. This is just shows the amount of millionaires in the U.S. They'll have to meet certain requirements, but it'll be a little less than 9.6 million that could possibly run a hedge fund if they would like to. So the biggest things that separate hedge funds from regular funds is their investing strategies. Leveraging is a tactic that it's just basically using debt to increase your gains, but it also can exaggerate your losses. Long-only strategy, you're just betting on assets that will increase more than a benchmark index, such the S&P 500 is the usual one that they use. A short-only strategy, you are looking for assets that will be decreasing, and you'll be hoping to short that and then just borrow the investments and buy to cover at a lower price to make a profit on that. A long-short position is used to kind of offset your losses or gains. You're kind of protecting your investment if you just based on where the market is going. It's usually pairing trades in the same sector to take advantage of, say, Apple stock going up, Microsoft's will probably go down. So we'll do that. A market neutral position is used in a volatile market. It's just using a 50% long trading and 50% short just to even out the profits and losses in that market. Relative value arbitrage, when a hedge fund manager sees a price discrepancy in two related assets, it's usually debt. They will short one and buy the other, and then when the prices converge, they'll be making a profit off of both their investments. And equity arbitrage is very similar. It's usually used for taking advantage of a takeover. If the larger company is the acquirer, their stock will usually decrease and the acquisition's price will increase. So if you short the acquired stock and go long on the acquisition, you'll make a profit both ways on that. Distressed debt, buying bonds of companies that have been devalued, and they're hoping that the company turns around and they're able to then sell the bonds at a higher price than usual. Event-driven, they utilize information to make a quick trade based on where they think the market will go. It's just usually a really quick trade. And then quantitative, just high-frequency trading that make rapid trades, and hopefully the sum of all the profits of the trades will add up to make a much larger profit. Buying on margin is one way to use leverage. So say you have a stock that is at 110.
I gotta cut you off.
All right.